stock market for a few minutes before it closes for the day, and we have our buddy Doug Flynn joining us from back in New York, course certified financial planner, regular on our show, the co-founder of Flynn Zito Capital Management. Couple of things, Doug. So not that necessarily where the market is today, I know it's down a little bit. It's actually been up a little bit the last few days, but the GDP. So that came in obviously with a contraction. So basically, the way I read it, the whole idea was a lot of people were looking at companies and said, all right, we got to import all this stuff ahead of the tariffs. So imports went way up, right? Exports weren't so great. So what did you read into that in terms of, is it the start of a recession? Because, you know, a lot of people know the definition most economists use. You have two of these, two down quarters, you're in a recession. So where are we?
Yeah, it's a good question, because what happens is the key letter in GDP is the D. It's domestic, gross domestic product. So what happens is when you have a flurry of imports, which we had anywhere from 40 to 50% higher imports than we normally do, that drives down the domestic part of the equation and actually accounted for about 5% of in points on GDP. So it drove it negative. Now things have gotten weaker, but you have to look beyond just the headline number. And so when you look a little deeper, you find that there were some strong things in there, like consumer spending, business investment, all of that was up from the previous quarter. And if you look at core GDP, which excludes that, it's actually up 3% year over year, which is the same number we were at last year. So there is a headline negative number. Those 8 people at the NBER who actually determine whether we're in a recession or not, you can take those 2 negative quarters as a general rule, but there's these 8 people that actually determine it. So we would need more than this to actually say we're in a recession. We're not officially in. You can't say we're in one now.
Right, and they often tell us afterwards, hey, God, by the way, you guys were in a recession. A lot of good that does us now, thanks. But that's the way it often works. What I think is interesting, one of the things interesting about, if you think about it, all of what's happening right now is not happening yet. Even the numbers are decisions that are being made in anticipation of something happening. So, you know, theoretically, if it all worked out for the president and his plans, you know, this all could reverse itself, I guess, right? The market could come roaring back, the economy could come roaring back. But it's this, everybody's preparing for something that they think is going to happen as opposed to reacting, which is interesting. Like even like the ports now, we do see some early signs, however, that things are slowing down. So I guess it's a little bit of both.
Yeah, and next quarter you could actually have the opposite effect, because what happens is if everybody front-loaded all of their imports, and now we're good, we stocked up, we're ahead of it, and now you don't need it in the next quarter or two, then the domestic part is going to come rallying back because you've pushed down your imports. So as most things in investing and looking at the economy, no one number tells you everything. You have to take it in the preponderance of everything else. It is one number. It's something to look at. It's kind of what we expected, with some things weakening, but other things are hanging in there pretty strong. The consumer, the most important one. And so you need more than just that one number to really say, hey, my personal economy is one thing. This overall U.S. economy is more than just that. And we need a little bit more data to really say, hey, recession's definitely coming.
So you're a long-term guy. That's what you do. You deal with clients, as we've talked about it on the show many times. You know, they're talking real people. They're talking about their retirement and what they should do with their money. So it's not a day-by-day thing. So like a lot of people in the market today are talking about the president's comments, which I would dismiss. I think a lot of people support the president would dismiss this idea that, you know, somehow Biden's fault that the market is down. The market, as I said, again, we're looking at the future. The market's a forward-looking mechanism, the stock market, and it's scared about the future. The tariffs are the reason it's down. The anticipation we were just talking about. So put that to the side. What should people do? You know, like, is it a sit-tight type of thing still? Because there's still a lot of uncertainty. We see that from companies. Like, you know, GM the other day says we have no idea how to put a forecast together. What should regular people be thinking about right now?
Yeah. So the first thing I do is I look at the last 12 months and say, what is the market up from 1 year ago through the crazy election, all of this? And would it surprise you to say that, to know that if you go back 1 year through today, the market is up 10% year over year. So through all of this, you got the long-term average return of the market these 12 months through today with all of this insanity. So that is kind of what you expect when you extrapolate that out over 5, 10, 15, 20 years. And that is the way you need to look at it. If you're looking at it from the high a couple of months ago, yeah, you're not as high as you were, but you need to stretch it out a little bit longer than that. So all that noise, all that stuff that's going on, that presents itself with opportunities if you have some money on the side. As always, we say, if you need your money in less than a year, You should have been pulling that off and putting that on the side in the first place. Don't wait till the very last minute and leave it in the market, because anything can happen in the short run, but in the long run, that's really what you're looking for. These companies are going to adapt, they're going to adjust, they're going to do what they need to do, and they're going to thrive. Otherwise, those CEOs are not going to get their multi-million-dollar payouts, and you know that that's what they want. So, Doug, they're going to make it happen.
Yeah, right. They always do. Doug, as you know, we've known each other for many years. Our sons played baseball together many years ago, and all that kind of stuff. I've always said you're a very, very positive person. Very positive. So when you started talking, the market was down. I think you just about got it higher. It's down a little bit.
Come on,
so
let's go.
So that's what you did, and now we've hit 4 o'clock. Thank you, my friend. We'll talk to you again soon.
Thank you.
Doug Flynn, it's closing bell time.